think it's okay. All right, guys, we are officially live, all right, in actually both YouTube and Facebook as well as TikTok right now, all right. If you can hear our voice very, very smoothly, that means you can still catch me, all right, hear our voice, please type V in the chat, please type V. All right, because tonight we are going to have a very, very amazing investor. And in fact, he's sitting beside me right now. Marvin, he has 15 years of investing experience, and I know lately a lot of people are very, very scared, right, because the market has been keep on coming down and down and down, and they're wondering exactly how can they construct an all-weather portfolio. And I believe, right, Marvin, because has been through so many years of investing experience, he definitely know what is the right way to construct a portfolio so that we can give you some advice, all right, to help you better. All right, but before that, maybe let Marvin do an introduction of himself first.
Okay. First of all, it's an honor to be part of your live. I watch your videos a lot in TikTok, and you give so much value and content to people that maybe are scared also to enter the markets right now. So it's an honor to be here. Yeah, just a quick background of myself. I've been,
Yeah, I think so. Okay, I will have to quit the TikTok then. All right. So
yeah,
guys, sorry, we have to end the TikTok because there's feedback. All right, very bad echo. So come and join us if you're on
yeah.
TikTok right now. If you're on TikTok right now, come and join us in our Facebook. Go to Arigato Investor on YouTube. You are on YouTube. Then you'll be able to find our live right now. All right. So we will see you there in YouTube. See you. Okay, so we were trying to test out our TikTok live at the same time, but it doesn't seem to be working because there's feedback. So once again, let's welcome Marvin to do an official introduction about himself first.
Okay, so yeah, I started investing in my early 20s when I graduated from college, and then at that time I really wasn't keen on investing in the stock market yet. I was a big Robert Kiyosaki fan, and I read a lot of his books when I started out. And as I read a lot of his books, I was more keen into starting businesses. Uh, One of my goals when I was starting out was I wanted to franchise a very small dim sum kiosk and then put it near an MRT station, and that was near my office. But that was my goal. But while I was thinking about what business to start, also, I did some small side hustles where I started to earn money, and as I started to earn money from those side hustles without knowing yet what very expensive brick and mortar business to start, I said, why not just park it or invest it into something so that it's not losing money to inflation. And I tried different things, but one of
Mm,
my first investments was a equity fund, mutual fund. What's interesting about that was I was watching my mutual fund almost every day. Then I said that if I'm watching my mutual fund almost every day, why not start investing and trying things on my own? And when I started trying it on my own, I felt it was something that was fascinating. It gave me the ability to be able to do things at my own terms, at my own time. And I was working as an IT consultant, SAP for Hewlett Packard, and it was something that I could do while I was also an employee. So I figured out this is something that's interesting. This is something that's amazing because I get to open another stream of income while I'm employed already. So I have one stream from my work, then I have one stream from side hustles. Then the revenues from that I could put in and invest in equity funds, and then eventually into the stock market. And as I started to get into it, the 2008 crash happened, and I was a very big fan of Warren Buffett. And it, at least from the first exchange where I was investing in, it didn't make any sense. Why did they crash 50+%? But I saw the business as something that, how come they dropped a lot but they're not really affected from a revenue standpoint? They were at least relatively good. They still had customers, and I said that this might be an opportunity for me, especially right now that I was in my early 20s. At that time I was already thinking long term, that I said that if I make a mistake on this investment, it doesn't really matter, because I was planning that early 20s I would touch my money when I'm 60 years old, because my concept at that time when I was younger was retirement is 60 years old. And of course that changed over time, but I said that if another recession will come in the next decade or so, I don't need the money yet because I will use it when I'm 60 years old. So I just kept on accumulating also at that particular point in time. And what gave me also the strength also during the 2008 crash was I was employed. I had sources of income. I was living with my parents. I had savings that even though there's a potential that the market could still crash and go lower, but it won't affect the way I live. And then I just fell in love with it. Then the market recovered. And it was something that I felt that I really wanted to do over and over and over again. So just a
Wow.
brief background, I guess.
Wow, but I think like it's really not easy to stay the kind of long-term mindset, especially at your initial years of investing, right? At that time, like, did you feel any, like fear at all when the market keep on dropping every single day during the '08 financial crisis, which actually dropped like close to 50%, right? Like, was there any fear? Like, how do you overcome that?
Of course, it's how do I say this? It's it's not it's not a happy moment when you put your money at a certain point and then it goes down, because at the back of your head you will always think, I should have waited a bit more because I could have gotten it at a lower price and I could have gotten more shares. But at that point also, I was very young. I was in my early 20s and I already had the mindset that this next few years, what my focus is not to earn first. My focus is to learn first, and whatever I will learn, if I earn from it, it's the earning is just a benefit. But I want, my goal at that time was to build as much skills as possible, so that in the next 3, 4, 5 years, as I started to build the skills, that's when I start leveraging it or scaling it. And I guess I want to submit this to a lot of people. When we are in elementary or when we are in grade school or high school, wherever you are in the world, we spend more than a decade to learn whatever course or whatever profession you want to be in. When it comes to investing, people are so hard on themselves that when they don't perform on the first 3 months, on the first 6 months, on the first year, they're so down, or they look at, or other people also look down when you're not performing on the first year. But if you look at it from a perspective of learning as a student, or even if you're a fresh grad working in your first job, no one expects you to be good in your first year. No one really expects you also to be good right off the bat. And that was my mindset also, that I'll try to learn first. Then whatever I would earn will be a jackpot. And my mindset at that time was this. In school, you pay for you to learn. The stock market is so amazing in a way that where can you find something where you have the potential to earn but you're also learning at the same time? And I was also thinking at the long view. I started investing 22 years old, so I was thinking about, what if nothing happens from 22 to 27, but when I hit 28, 29, 30, 31, suddenly all of the learnings in the first 5 years would be better for me. So I wasn't in it to get rich quick for the next 8 minutes. I was in it to build something that will benefit me also later on in life.
Wow, I think that's a super, super amazing mindset that you focus on learning rather than focus on earning. Because I think most of the time when people decide to go into the stock market because they actually want to get rich, and if possible get rich quick, right, and that end up causing them to make a lot of emotional decisions that end up losing money. So when you start with the mindset of learning, that really give you a different, give set you on a different lane, right, and you really become much more objective and logical when it comes to investing. Is that right?
Yeah, and I was under the concept that, so everyone who wants to invest always thinks about that, this is gonna go up, this is gonna be good,
Yeah.
this will help my retirement. But at the very onset already, I already figured out that, what if it doesn't, what if this goes down? So in everything that I do, even up to businesses that I try to invest in right now, or stocks that I try to invest in right now, I always look at what would be my downside first,
Mm.
how low it could possibly go, because I want to tell this to people that if you focus on the downside first, the upside will be a bonus for you. Whereas
Mm.
everyone thinks that, I buy at 10 now, how much will my money be when it hits 20? I don't look at it that way. I look at it with, what if I come in at 10, it goes to 8, can I tolerate it? Can I sleep well at night? Will it be a good investment for me? If it goes down to 8, do I add more? Do I cut loss? Oh, I think about scenarios first in the downside. Or on the contrary, also, as I got older, I went into even more riskier investments, that I would always ask myself, what if this goes to zero? Am I okay? Am I exposing the right amount of money that, if it goes to zero, will it hit my entire portfolio? If the answer is okay, it might damage me, then I try to lower it. I try to lessen the exposure. So it's more about looking at the downside first versus the upside. Because this is my belief, Chloe, that uh, if you focus on the downside, you focus on building the skills first, the upside, whatever earnings you will get, it will eventually happen. And what people need to realize also, it won't happen at the pace of what your friend is doing, because some people might get it in the first 3 months, some people might get
Yeah.
it in the first year, some might get it in 4 years. We all have different learning curves. So what's so important is you don't compare your performance with how everyone else is doing. But what's important is you compare where you are based on what goals you have. Meaning, if my goal was just to accumulate as much so that I could get this amount when I need it later on, as long as I'm moving toward that direction, it doesn't matter to me how other people are performing, because my eyes are focused on where I need to go, not where everyone else is going.
Wow, I think it just in the first 10 minutes, you're already sharing so much golden wisdom. How many will find that has been useful for you? If it have been useful for you, can type you in the chat, all right? Help us to share out these posts to your friends to really inspire them, especially your investing friends right now. I know a lot of them are very scared right now due to the stock market condition, but I think such investing mindset, it's very, very important to start cultivate to really help them to go on the right track. And in the meantime, I also want to ask the audience here, how many of you are very new to investing? If you are new, type new in the chat, right? And yesterday, in fact, I was just talking to two of my friends, and they are very new to investing. They started investing like since last year, and this year the market dropped so much, and their portfolio right now is in like I think 50 to 70% in losses, and they were very scared, and that's why they asked me for advice, right? And they say, oh, we are so unlucky, the moment we start investing the market start dropping, right? But you can see the mindset between Marvin and them a very different. Like Marvin, he also I think the first year that you enter the market 2008 came, right? And then it was a huge drop for you, but Marvin focused on learning. And in fact, this is what I told my friends as well, like focus on learning, and you should consider yourself lucky to be able to experience this kind of crisis right now as a beginner, because you don't want your portfolio to go into like $100,000 $200,000, then then you experience this kind of drop, right now when your portfolio is still small as a beginner, you should be happy that you experience this and you learn from it, right? So while I can see many people are very new, all right, so I think Marvin later on is going to share with us a lot more golden insights. So talking about the downside, just now you're talking about like you always think about what can really go wrong, and from there you make an investment decision whether how much percentage to allocate and all this, right? So how do you protect your downside? Like what do you do with your portfolio so that you can better protect your portfolio and build a more all-weather portfolio?
Okay, that's a very good question. But of course, there's different people listening to this, no, and we all have different sizes, different amounts that we're actually investing, and the answer to that could be very, very relative to people. Let me give you an example. For example, Chloe, Arigato investor, sets like a target. I want to have like maybe $1 million all in all total, and then you are say at 100,000 right now. So that actually means that even if the market goes up, you double your position from 100 to 200,000. Getting 100% return is amazing. 100 to 200,000 is amazing. But when you look at it from the grand scheme of things, your goal isn't to double your portfolio. Your goal is in totality to get a million US dollars or Singapore dollars, whatever target you actually want to get. So the answer to that is this: uh, if you're just also starting out and you are trying to put in amounts of money, and then it's down, and then maybe you just put in a smaller amount of money yet, but you're putting money on a regular basis, because some people, when they have salary, they allocate certain amounts for investing, and that certain amount over time will be bigger than the loss that you have, then I think it doesn't really hurt as much, because the amount that you can put in can compensate for the amount that's currently there. It's a different scenario when you have a larger amount already that's placed in. Then when it drops, if you add more, even if you average down, it doesn't really change the percentage of it already because there's already more. So to answer the ones that have bigger portfolio sizes already, I think they should do it in a way that, number one, we all have different comfort levels. So every time I would invest into something, I always will. There's a mental check in my head that if this drops by an X percentage, or even if it goes to zero, can I tolerate this? That goes per asset class, and that also goes per stock or per crypto that I may want to buy. So, for example, if I put, give me an amount, Chloe. What's an amount that you want to talk about? Just
So for
for
example,
example,
$100,000.
okay, $100,000. So say you put 100, you want to expose $100,000 in the stock market. You ask yourself that question. Large drops, 10%, 20%, 30%, 40%, 50% drops, depending on what you can tolerate. Are you okay that your 100,000 would drop that much? Then you drill in deeper. You ask yourself the question that how many stocks would I want to expose myself to? 5 stocks, 7 stocks, 10 stocks. But just for the sake of this video, say you decide, okay, I just want to buy 4 stocks, so 100,000. And then you say you want to balance it out equally, meaning 25,000, 25,000, 25,000, 25,000. Then you ask yourself this: say for example you want to buy Apple stock, um, 25,000 on Apple stock. Should that decline even further, can you tolerate it? If the answer to that is no, that actually
Mm,
means a couple of things. Either, number one, you lessen your exposure from 100,000, you make it smaller, or you, from 100,000, instead of buying 4 stocks, maybe buy 6 or 7 or 8, meaning your
mm,
size has become smaller. Because people need to realize this: it's not the percentage drop that makes people scared, it's the amount of exposure that you have. Because your
mm.
stock could drop 50%, but if you only place, say, $10 or $20, then it's not life changing, it's not
Yeah.
devastating. 50% drop for someone with a million versus 50% drop with someone with $20 are two different things. So my rule of thumb is this: if I feel that I'm exposed too much already, that I feel uneasy with a certain amount, I I remove some of it already, and then I transfer it. So this is something that's interesting. Where do I transfer it? My goal is, my goal in everything that I do in the market is, if there's any gain, I would use that gain to buy dividend stocks. So the
Mm,
proceeds, so I don't use my capital appreciation and use it to be able to enjoy life or to buy whatever. Or if you watch Chloe's videos, those expensive bags that she's showing in her in her videos, I don't use it to buy those stuff. My goal is, every time there's a winning trade, or it feels that the position is bigger, I'm uneasy, take some of it off, either buy dividend stocks, preferred shares, or bonds. So even if those stocks, also those dividend stocks, would go down, it doesn't matter anymore, because it came from the proceeds of the gains. And I'm not in it to trade it. I just want to get the cash flow from what the dividend stocks would give me. So yeah.
wow, wow. Like you can see that Marvin, he focused a lot on actually really building up cash flow, the kind of passive income, because he knows that even with the stock market drop, he still has the amount of cash flow coming in and he's not so worried. And I think a lot of times when it comes to investing, many people really focus on growth, right? Like growth stocks. But the problem with growth stock, which lately I've been talking to one of my investing friend as well, the problem with growth stock is they can grow a lot, right? But then they could be just paper gain. But what if, it started to drop, right now, for example, what's happening to Meta right now, you can see that Meta dropped to the price that was the exact same price 4 years ago. So if you bought it as a growth stock, which Meta doesn't give dividends, literally these 4 years of you holding onto it become nothing, right? And you literally gain nothing from it. But if you invest certain part of your portfolio into dividend stocks, despite of the drop, well, you still have dividend coming in every year, right? And that's how that is passive income, that is real actual cash that you receive. And I think that can give you a peace of mind during this period of time. And talking about exposure, right? Like Marvin just now, he talked about what is the maximum downside that you can take. Then you can allocate your portfolio accordingly. So, do you have any advice in terms of, to beginners, what is the number of stocks that they should be looking at into their portfolio to manage the exposure?
Um, that's very subjective and very
Mm,
relative. So I've written 5 books about the stock market, and on my third book, it's called Stress Free Investing. I tackled something where I talked about portfolio allocation, and what I did as part of that also is I interviewed different fund managers, and I asked them, how much should people actually put, how many stocks should they actually buy, and then I gave different amounts. And what's interesting about that, I interviewed over 50 fund managers with different exposures. They all gave different answers, so it came to a point that it's something that I think it's very relative, but it also will go back to the size of what you have. Meaning, if you feel that it's, so people always say that you have to diversify, but if you're starting with a very very small amount, and small amount also is relative, it doesn't also make sense to diversify that. It would be better maybe just to go all in. Say $100. It doesn't make sense to split that into 10 different positions or 5 different stocks. Also, it doesn't make sense. What
Mm,
what what you can do is this is so what I'll do is this. I'll make a scenario. If I'm just starting right now from scratch, what would I do? And I'm starting with a small amount of money. What I do first is I would focus on one stock first. Maybe regardless if I trade off of that or accumulate off of that, then say it comes to a point where it's something that I'm not comfortable with already. Exactly. I'll just give an example. So I'll start with $1,000, then it becomes $2,000. When it comes to a point that, hey, I don't think I'm comfortable with $2,000 anymore in just one stock, then maybe that's when I decide, okay, okay, one stock $1,000, another stock $1,000. Then it increases again. It becomes $5,000. Then you say already, I'm not too comfortable $5,000 to stocks. Then maybe you could decide already, okay, um, I'll split it maybe 3 stocks. If you
mm,
notice, if you notice it, it's there's no hard and fast rule. It's all about what you can tolerate and what your gut feel is already. And then just to speed things up, if it becomes even bigger already, and then it comes to a point that my entire portfolio, I've already split it into 10 stocks or 8 stocks. I'm not comfortable already. That's when you take money off, buy bonds, buy preferred shares, buy dividend stocks on a separate
mm.
on a separate portfolio
Account.
allocation already, so that even if this drops, you've taken money out, but the money that you've taken out also is giving you already cash flow, and then that's where it becomes passive income also for life, which Chloe
Wow.
has a lot already, guys. Comment below if you believe Chloe has massive amounts of money. Type in the comment box below.
I'm pretty sure mommy has more money because he has been investing for 15 years and he profited during
fake,
the 2008 crisis. And right
fake,
now, I think
fake
he's
news.
using the same approach to buy more during this period of time. And okay, so I think very good question, right? In the meantime, I'm also very curious in terms of, I think the listeners here are also very curious, like what kind of mistakes do you think, maybe just one or two gravest mistakes that you have made so that they can learn and prevent in their own investment journey.
Okay, I think you asked this question when you were in my channel. No?
Yeah,
And this
yeah.
was
Oh,
something
by
that
the
was
way, Marvin, he has 300,000 like subscribers on YouTube. You can go to his YouTube channel, which is, I put down the link below, right? Just search for Marvin Germo, you'll be able to find 300K subscribers. Wow, amazing.
but congratulations to you, Chloe, at 200,000 TikTok Arigato investor. Congratulations, that's amazing. Um,
Thank you.
so a lot of the so here's what's interesting. People always think that the longer you are investing, the mistakes become lesser. But for me, I tend to experience different types of mistakes also. Sometimes it's also out of sheer carelessness. I think I mentioned this in the video that we did in my channel that um, one of the mistakes that I had was I forgot to change the leverage of a certain position. So I was looking at it. I was looking at it at that time. It was a couple. This is recent, just this year,
Mm,
a couple of months back, and then it was a new platform that I did not use before. I was used to certain platforms that the leverage the default is 1:1. So I assumed that this platform also was 1:1, and there I didn't take a look. Then after a few minutes, I got a notification. I got liquidated, only to find out that the leverage for that, I think, was 100 plus x already. So just one quick
One drop.
swing. Yeah, I got liquidated also. I think I think that's one. And then not being too careful in those minute details. Number two is this. So this wasn't part of the questions yet, but I'm exposed into different asset classes, stocks, crypto, bonds, ETF, REITs, etc. The problem with that also is if you're exposed to a lot, there will be some times also that you won't be able to watch everything, or if
Mm,
there's one news that's happening here, and then it's spread out, because my strategy, and I've been doing this even for stocks, is I try to open different brokers, different platforms, so that it's not everything is in one account. I'm just really paranoid that way, that if this closes, at least not everything is there. And not just that, from a tactical perspective also, that this one will be for growth, this one will be for short-term trading, this one will be for dividends. But the problem with that is, in I'm not sure for people watching this if they've heard what happened to Luna and USD.
yeah.
Um, there was one, I had some exposure in USD, but it was split, and I totally forgot that there was one in another platform that I totally forgot to sell. And then when I remembered it, it didn't have any value. It didn't have any value anymore. So I guess a lesson on my part there is, it's okay to be diversified, but when it's too much diversification already, there will be some that will slip through the
Your mind.
crack
Yeah.
also. Yeah,
Yeah.
and you might also get hit. And I can go I can go on and on and on, even for trading. You set a stop loss, and then you set a stop loss, it's already at the support, and at the back of your head, oh, it's okay, I'll remove the stop loss, I'll remove the auto stop loss first, because I think it might bounce back already, because it's already oversold. Looking at the RSI, it's already oversold here. But to find out also that it went down even more, and then you end up losing more money. So uh, there's a lot. What I guess moral also from what I wanted to share to people is that, as long as you know how to set aside cash, and you know how to diversify, and you know how to separate it into different asset classes, no matter what mistakes you have, as long as it doesn't cripple your finances, I think it should be okay. There's a learning attached to it, because people always say it's okay to have mistakes as long as you bounce back with it. That's true, but if the mistake also cripples you, then
Mm.
you lost a lot of opportunity also. So I was okay making a lot of mistakes, as long as those mistakes uh, were not um,
Devastating.
yeah, devastating from a
Mm.
financial point of view, that I'll still be able to eat, I'll still be able to do whatever I could actually do. It's not life altering or life changing, something like that.
Yeah, yeah. So it's always about, once again, like what Marvin said earlier, it's about protecting the downside, that he is able to foresee if this goes to zero, is he able to take it? And it doesn't. If it doesn't, then he will modify accordingly before making that investment decision, right? So it's always about protecting the downside. Can everybody type protect the downside in the chat? I think that is a very, very important philosophy, especially during uncertain times like this, right? So I mean, like for yourself, right? I can see that you really have this capability to have multiple, investment instruments under your portfolio, right? And I'm also very curious, how is cash being part of your portfolio? Like, do you put like certain amount of money as cash? Because I remember you do share with me that concept, which I think is very important. Can you share with the listeners here as well? Am I lagging, or is Marvin lagging? Okay, guys, let me know. All
Agree.
right, if I'm lagging, am I lagging? Am I lagging, or are you lagging?
Yeah, I got this. I'm back. I got disconnected. Yeah, sorry about that.
Okay, okay, yeah, yeah. So, so
My
did you
wife, I could
manage to hear my question? Did you hear?
no. My
Okay,
wife, I heard you said cash.
yeah,
I think you heard you
yeah.
said.
So I'm also very curious. I think the followers here are also very curious in terms of like, what is your cash position uh in your in for example right now, right, with the market so down, what is your cash position? How do you manage cash with your investment portfolio?
Oh, okay. That's a good question. So I set aside cash that's not totally related to my investment. So my decision point is every time I put something for an investment, regardless if it's stocks or crypto, that's pretty much I have every intention to fully utilize it as long as outside that particular. So for example, this is stocks, this is crypto, or this is other assets. If I have cash here, it's totally unrelated anymore. There will not be a point where I will get this cash to put in there. The only time I would put in cash here in stocks or crypto is that if I have new funds that I decided, okay, I'll add more to this particular asset class. So my cash from a total portfolio perspective is totally separate from my investments. That I What's very important for me is I have number one, cash that I could use for my operations. It started first before that I needed a few months, then it started to increase that, okay, what if the market crashes, nothing happens, nothing comes in, I need to have at least X number of years also, cash that could be actually stored. Then I try to build emergency funds also. Then I'm pretty much a planner, in a way that everything I try to allot cash for. So even from a budgeting perspective, I would set aside cash for, I think I mentioned this when we did the video in my
Mm, yeah.
YouTube channel, that I would set aside cash already for my child's future
Education.
college education, and I was doing that when I was in my early 20s already. So I pretty much set aside cash for different facets, and then whatever I put in for investing. So the whole goal is to exercise that to the fullest extent. Now, in this investing portfolio, it already depends on what current position that I have. Meaning, if before the crash, I was fully positioned already, then the only time I would get cash if I would infuse capital. But if I had like 20 or 30% cash available for me, then the market would drop. Then the next viable thing that I would look at is if it's the stock market. I would look at it from if, so from an investing and trading standpoint, two different perspectives. If it's an investing position, I would look at it already. Who are the list of companies that I really like, and then I look at their PE ratios, which is the one that's cheaper, and then based on the drop or the ones that I think that are not affected as much, the cash that I have, I'll try to allocate into those that have dropped. From a trading perspective, normally when there's large drops, I I'm very simple in trading. Support resistance, moving averages, MACD, RSI. So when it drops, also I just look at RSI. The ones that are oversold near the support, those are the ones that I try to prioritize, and I try to allot specific amounts off of them. So there, I don't really have a specific percentage on what I will try to maintain in this investing portfolio. But what I've learned also over the past years is that um before I would try to, okay, I'll just buy in one go, and then you live and die based on off of your conviction, and then I'll just buy in one go because I bought it at the support. If I bought it at the support, it's supposed to be somewhere where it's ideal also to start buying, since it's at the support. If it drops, then I just cut losses. What I've realized as I got older was there's still wisdom in tranching it, that I'm not here to get the exact bounce from the support, but I could, as long as I get it near the support, somewhere around that area, or even if I buy near at the support, and as it bounces, I buy all the way up. Also, I'm fine with that. So, uh, yeah, if I run out of cash, if I earn more, I'll try to infuse my investing portfolio with more cash. If at the point that it drops and then I have cash still, I'll focus on the ones that I could deploy capital on. So, will I take money out from that? Not really. There's a reason why it's in my investing portfolio, because it's there to be an investment for me that I plan to use and maximize as well.
I see. So, like you can see that Marvin always has two, like different separate accounts, right? And cash to him is really for safety, for his own expenses, rainy day funds. So it's very important that you don't invest everything, right? You really should have an emergency fund, and that actually gives Marvin that peace of mind, right? Even despite all the drop that's happening right now, he knows that his next, few years ahead are well taken care of with just the cash that he has, and he doesn't have to worry and make reckless investment decision because of that. And I think there's also good questions coming from the floor. The safe investor is asking, what is the best indicator you have used? And since we are more investors here, maybe you can share with us investing indicator that you personally use. Yeah.
Oh, so you mean invest technical analysis, or you're talking about
It could
fundamentals?
be maybe like valuation. Let's talk about, because right now I think the stocks are really good value right now. Like what kind of value metrics do you use?
Okay. So split portfolio for growth, and then for dividends. For if Let's focus on dividends first. For dividends, what's very important for me is basically this. I have a certain dividend yield in mind. If the stock drops and then the dividend yield is higher than what I wanted, then that's automatic something that I would focus on already, because even if the stock would drop and then the dividend yield is not at the price that I want, at the percentage that I want, I would still ignore it. So that's from a dividend perspective. And just to note also that um, very very important that the fundamentals of the company doesn't change while the price is also down, because the ability for them to give dividends in the next years also talks about how good the company is today, so, or at least if they're not as affected. So I look at also what's actually happening. Did the price drop because it was just something that was systemic around the world because of what's happening with interest rates? Because generally now everything is down mainly because of the Fed, mainly because
Mm,
of the war in Ukraine, mainly because of inflation. But there are companies that are really hit because inflation is higher, because the dollar is stronger. But there are companies also that they're not really as hit also, even if inflation is higher. So I'd like to focus on the companies that are not as affected with this, and then the price is down. And then as long as the dividend yield is good, I'm okay with that.
mm,
Then from the ones that are not into dividends, I look at a couple of things, and I look at, as long as the sales and net income from a year on year basis is continually increasing, and then there's no really threat from a quarterly perspective that the sales and the net income is lower, I'm totally fine with it. Then I look at some metrics. ROE, I want it to be at least above 10 plus percent. Then I look at some points the debt to equity ratio also. I don't want them also to be overly leveraged. Then I look at also the quick ratio, the current ratio. I check how liquid they are, especially in times like this where you have
yeah.
rising interest rates. I want them to have as much assets that could cover just in case their income also gets hit. Then when I look at all of that already, to look at if the company is sound and all, etc., that's when I look at if it's cheap from a PE ratio perspective. So there. But
Mm,
just to say that also, sometimes when you're looking at tech stocks, for example, you're looking at Tesla. There was a point that they weren't really making money yet. I still liked it even though they weren't making money, because
yeah.
it was more of a macro bet also that uh, everything's gonna go electric. We're not gonna go backward anymore. We're not gonna use fuel. We're not gonna in 2050 the world's not gonna say, okay, let's go back using diesel and gasoline. We're not gonna do that. We're just gonna go electric. So it was a bet on that. And second, it's Tesla's a brand. People like to buy Tesla now because it's cooler than um, other cars that are out there. So
Mm.
so there are some exceptions to the rules also. So I hope that answers your
Yeah,
question.
definitely. I mean, like different companies, there are different ways that you evaluate it as well. So if we go back to the current market condition, right? Like, what do you think? Like, what's your advice for investors, right? Like, do you think that with the uncertainty, what should investors be doing right now?
Uh, so this should be a time where this is what I believe. Couple of things. Number one, in uncertain times, that's where there's a lot of opportunities. But also in uncertain times, you just don't throw money like you're throwing a dart
Mm,
blindly. That's where your conviction gets tested, and that's where also it will be more of conviction bias. Meaning, at this point, you should spend a lot of time to study. When I say you spend a lot of time to study, that you have full conviction on what you want to allocate from. If you're, I'm sorry, I'm talking to long-term investors here also, because if you're trading, you can just use technicals and it doesn't matter also, because you can go long or you can go short. But if you're a long-term investor, um, and you feel uneasy right now because of what's going on, then what actually you should do is you should spend time to research on
mm,
one, two, three, or four stocks that you really, really like, and build the conviction off of it. And as you start studying it, and then you actually see that, okay, whatever's happening right now from a business point of view, it may just only be temporary for this company because
Mm.
maybe they have a very, very strong brand, or probably they just got hit right now because there's a logistical problem around the world. That's why chips are harder to go from one area to another. But when that gets fixed, the company's so good, it's gonna turn back up again. If you study it from that perspective and you have full conviction, you that's when you start to invest. However, if you're not yet fully convinced, or you feel uneasy, or um you don't think that positioning in these companies right now you can put more, especially when it's down, then another alternative is just to go the S&P 500 route, just to
Mm.
go the index fund route, because at least for sure there, people need to
Yeah.
realize this: when you buy individual stocks, there's a chance that the company that you bought could go bankrupt and your money could go to zero. If you buy the S&P 500, they get recalibrated X number of months in a year. Uh, Meaning, at a certain point in time, even if you go back to it 10 years after, it won't go bankrupt because the companies that are there are changed also on a
Yeah.
regular basis. And if you study it in history, um, it's normal for the S&P 500 to go down. But if you study it also, it always bounces back and it always goes back higher than where it was before. So also you need to consider this: if you're watching this and you're 20 years old, 25 years old, 30 years old, and then you say, I want to use my stock market money when I'm 40, 45, 50, 55 years old, investing at 25 for something that you will use at 55, whatever you do right now, it actually doesn't matter even if the market drops, because
Mm.
especially with the S&P 500, because if it goes back up higher, what you have right now, you get to actually buy it at a very, very low price. So if you have more time, build a conviction. If you don't have time to build a conviction, S&P 500, accumulate. And please remember this: I always say this in a lot of the in when people ask me about it, regardless if it's in talks that I get invited to, or even the videos. What's more important than the gains that you put in is the volume that you put in. Volume, meaning the amount that you invest over a long period of time, is more important than the gains that you would get. What does that mean? Um, I would rather have 10 million earning 10% than 100,000 earning 100%. Why? Because that 100,000 earning 100%, you can't do that every year. Eh. But when you
Mm.
have volume, 10 million at 10%, at least that's something that you can repeat. And the way you get to build volume is when times are scary, when people don't want to invest, because you get a lot of discounts. And when you have that over time, 25, 30 to 55 years old, that's a large amount of time that you can actually use to work for you.
Yeah, so I think once again, like Marvin is thinking super long term, that if you are building a future for yourself, like 20, 30, 30 years down the road, why do you have to care about this short term volatility, right? Because
Um,
long term, yeah,
just to clarify on that also, if you're trading, you could still manage the fluctuations. Eh? You could trade that day. But what's interesting about that is if you earn more, you just put it back in it because your base
yeah.
gets bigger. So from 1,000, for example, from $1,000, you earn 10% off of that. It becomes 1,100. The next time you make a trade already, your base isn't 1,000, it's 1,100. Then suddenly there's a bigger multiplier effect also on that. So I think it works even for longer time horizons or even for shorter time horizons as well. I hope it it helps.
Yeah, I think it totally is very helpful. And that's what we always encourage our students to always fund their account, right? Like their initial $10,000 is not the end, right? It should be the beginning. And every single month, as they have active income coming in, they should set aside certain amount of money to continue to invest so that they have a bigger portfolio. And when you have a bigger portfolio, even though you do not achieve like what Marvin said, 100%, right? Which is it's very hard to replicate every single time, right? Even the just 10, but 10% is so much more doable. But you have a bigger portfolio that it's on a 10% return and year on year, it's a meaningful income for your retirement fund as well, right? I think that's a very good mindset. Now, Next thing is, like I can see that you also diversify in different assets like crypto, bonds, stocks as well, right? Like, would you be okay to share with us, like what is your allocation in each one of them, and why do you choose to allocate such way?
That's a good question. Oh wow. I can't specifically remember what the percentages is right now, but um, I I I I I I think right now, if I would put everything latched together, I think I have more crypto already right now than stocks.
Mm,
I'll start everything off. When I was younger, it was purely stocks. But as I started to get older, I started to get bonds. Not from a percentage standpoint, but my goal for bonds was basically this. Um, People need to have a number that they want to get from in terms of cash flow. So it could be $1,000, $5,000, $2,000, and my goal was whatever I get as cash flow from this, it should ultimately it should ultimately get this sum of cash uh, later on. So I wasn't intentionally trying to do a percentage in terms of what should be my number for stocks, bonds, and at that particular point in time, my goal was whenever I would get something from the stock market, I would shift it into something that would give me passive income, bonds, preferred shares, and dividend paying stocks. And ultimately, what they would give me from a cash flow basis would be able to um, pay for expenses or at least be a cash flow perspective. So it started off of that. I don't have an exact percent. I don't know the exact percentage right now. What's the total difference between my stocks
mm,
that are purely for growth versus for dividends and for bonds? But if I would put it top of my head, maybe 60 for growth, then 40 from a cash flow perspective.
mm,
If you add if you add crypto, if you add crypto for it, it started out before that I would like stocks more than crypto, but as I started to learn crypto more, I started to add into it. When the market was higher for crypto last year, I think I had much more in crypto from a portfolio size perspective
mm,
than stocks, but because everything is also down right now, I think they're almost the same. So if I have $1,000 in stocks, I think I also have $1,000 in crypto. Top of
mm.
my head, I yeah. So I think that's the best way I could answer it as well.
Yeah. So once again, you can see that Marvin is focusing on building that cash flow as well, because at the end of the day, that's what really give him the passive income to fund his lifestyles as well. And actually for Marvin, he's going to migrate to Europe very soon next year. You can see the power
No
of
one,
investing is that you can
no,
migrate anywhere you want.
no one. I haven't told anyone yet. No one knows. I haven't
Oh,
told
off
anyone yet.
record. This one, okay, actually, it's not true. I was just joking. No, he's not migrating. He's not. He'll only be coming to
Oh my
Singapore
god.
to visit.
Oh my. Oh my god.
All right. So, next question is, like if you can, okay, now you didn't tell me it's off record. I'm so sorry. I will cut away this part. Okay, but anyway, next question is, if you can turn back time 10 years ago, right? What would you tell your younger self to do?
Wow. That I could tell a lot of things. So I would tell my younger self to buy Bitcoin, Apple stocks, but I, I couple of things. I don't regret um the life that I experience right now also. But whatever scenario that you have, there will be always consequences and sacrifices. Maybe one of the things that I would also try to think of was there were certain experiences that I should have done when I was younger. So I'll give you an example. I was in India in 2010. I was in Bangalore, and I also said this in my YouTube channel. But I was in India in Bangalore. I was there, and one of the things that I wanted to do at that time was I wanted to go to Taj Mahal, which was in Agra. which was, I think you have to take a hour or two plane ride, and then ride a train, and then ride another um, land trip to be able to see the Taj Mahal. But at that point, that was already 12 years ago. I was in my 20s. I said that, oh, it might be a waste. It might be a waste of money because I could save this money and invest it later on, and then it would compound for me. Looking at it right now, also 12 years later, I don't know if I'm gonna visit India in the next 5 years or in the next 10 years. And when I was there, I should have visited it. Um, I guess what I'm saying is this: we talk a lot about money, we talk a lot about investing, but experiences and time,
Mm.
when you lose that chance to experience it, or when you lose time also, you can never take it back, eh. So there were certain things that I wish I should have done from an experiential point of view, but I said to myself, I because I followed arigato invest. That's why I did not, I just invested my money. But looking at it from it hindsight, the money that I could have spent on those experiences, I could have earned back a couple of years down the road, eh. But there were
Mm.
certain things also that I wasn't able to do, and I don't know if I get to do it also again, or I get to do in the next few years. So
Wow.
I guess from that perspective, I wish I could have tried it. So now I'm 39 already. Turning 40 next year. I If there's a choice between experiencing something and also trading money for time or time for money, I would always pick trying to get more time, because
Mm.
if you watch the Avengers movie, you can you can manufacture more time, eh, and that's the only thing that you can have that is very finite, that you cannot take back also. So there.
Yeah, so I think it's a very good reminder for everyone here. Like as much as we are, focusing to grow our wealth, but actually at the end of the day, what is the objective of creating that wealth? It's the experience and the time that you want to create, with your loved one or even for yourself to pursue the things that you want to do. So during this pursuit, this journey, don't forget the whole reason why we get started, and don't sacrifice those experience and the time that we could have spent with our loved one while we are on this investing journey. I think that's a very good reminder, right? So for yourself, right, like some of the students here are also asking, may I know what's your key advice, for newbie investors? Maybe you can give us one to two key advice that you want to give to these investors.
Okay, that's a good question, Calvin. So if I was starting right now, also, um, I'd keep on trying. I would try all of the investments: ETF, REITs, individual stocks, mutual funds, insurance, crypto, NFTs. I'd put small portions with it so that I gain experience. So that what I know about it is not based on what people told me, based on what I saw on YouTube, based on other people's opinions. It's something that I've lived, it's something that I tried, and it's something that I will know if it fits me or not, or if it's something that works for me or not. Because the only time you know if an investment is for you or not, if you've actually tried it, if you've actually allocated it's different if you study it just by reading it. It's different if you try to. There's a lot of stock platforms right now that you can start to simulate, but it's different when you put your real life money there already. And what's nice about it, maybe with the exception of real estate or starting a franchise, a lot of those things don't really need a large amount of money. You can put small amounts, eh. So I would try everything, and then as I try everything, the ones that doesn't make sense to me, I'll remove it. That's why I'm not a forex trader. That's why I'm not a commodity trader. That's why I'm not also an. Chloe might hate me. I'm not an options trader because I'm not really good at it, because it's not something that as I tried it, it's not something that made sense for me as well. So my suggestion: try everything. And if you, as you try it, you figure out, oh, I'm actually good at trading forex. I'm just good at just trading maybe just the euro, just one currency. I go long and I go short every time I do it, and that works for you. uh go do that. But the only time you get to know that that works for you is if you've tried different things and put smaller amounts of money in it. Number two is this: two tips, right? Number two is this: um You need to surround yourself with people that uh think like you, but not like think like you also.
Mm,
Someone that will people that will challenge you. But lastly, this is so important to me. I want that in the room that I am in, I'm the poorest person in the room. I want to be the poorest there because the people I'm surrounded with, there's so much that I could learn from. The biggest mistake of a lot of people is when they have a rich relative, rich friend, they want their friend to treat them, they want their friend to give them good gifts, or they want their friend to give them money, or they have a rich relative, they want the relative to give them money. But if they give you money, they're shortchanging you, because if they give you money, the potential ends there. But if they teach you what they know, what they have, that's something that what they impart to you will be much much better than whatever monetary amount that they could give you. So change your surrounding, change the people that you're with. They should be the one challenging you, and you should be also getting as much and learning from them as possible. Because if you're not learning anymore, you're not growing. You're not being a better version of yourself. And if you're an investor also, that's why I love traveling, because I get a lot of ideas from traveling. It allows me to see what's happening in different parts of the world, and it allows me to see where's the arbitrage in that. This is already a technology that's here. It's not yet available here, but I know over the next few years it will catch up. Then I invest in this because I know as it catch up, people will also use it. People will also like it. Then the stock price would also get bigger. So learning isn't just by reading or YouTube. It's
mm.
more about experiencing. It's more about trying. It's more about um, who you surround yourself with, because there are a lot of things that you can people can teach with to you. But most of the things that will be life changing are things that you catch by actual practitionership and learning it by yourself also.
Wow, and you can see that Marvin is constantly testing, like he believes in the power of experience, right? He doesn't just read book and then never try it out. He actually really go and make an effort to test it out to see whether does he is it really suitable for him. If it's suitable, then he will continue. If it's not, then at least he knows it, right? And then before he decided to just really drop it and focus on something that he's really good at. So it's always about the experience. And most importantly, he's always focused on improving himself. And that's what makes him a very, very good investor today with a lot of passive income that's able to sustain his lifestyle for his family as well. And I think it's almost coming to the end of this interview. I also want to ask, what is your greatest takeaway? You have listened for the past 1 hour. Time flies when you are learning, right? What is your greatest key takeaway that you learned from Marvin for the past 1 hour? In the meantime, maybe Marvin can share with us, if followers want to continue to learn from you, engage with you, where can they learn from you?
Best place, Arigato Investor in TikTok. They don't know I follow Arigato Investor, but yeah, just search Marvin Germo. I'm in YouTube, TikTok, Facebook as well. I if you try to DM, I don't get to reply because there's a lot of people that would DM. But I guess the best place if you're gonna DM, Twitter and LinkedIn, because that has the least I think followers also. But yeah, I try to reply as much as I can. But if ever I don't get to reply, I do apologize already. But yeah, just Marvin Germo, TikTok, YouTube, Facebook, or wherever you see fit. Also,
Yeah, and I think Marvin shares a lot of valuable content, not just on stocks itself, also on crypto and everything. So if you want to explore, right, just like what Marvin said, experience it, explore, learn first. I think he has a lot of amazing.
Yes po. Okay, I got that.
Were you playing something just now?
Not sure.
I'm not sure. Suddenly, something pop up. All right. So anyway, all right, and that's almost an hour. So I thanks Marvin for coming here all the way just to share with us all your investing insights and your experience. And I hope all of you learn a lot. Right? But Kevin said that it's very very useful sharing. Thanks so much, Marvin, for coming here. And remember to just follow us on TikTok, YouTube, follow my Telegram channel as well so that you can keep your learning going. All right. And then most importantly is during this volatile time, never stop investing, because if you stop, then you are really going to like firstly stop your learning, and secondly miss out a lot of future gains that the stock market can give you in the long term, right? So thanks everyone, and have a good night, and we will see you in our next sharing as well. See you guys.